It's been a decade since the GIIN was formed. Time flew by, and in that time, there's been phenomenal progress around impact investing. At the GIIN, we spend a lot of time thinking about how to accelerate the advancement of impact investing going forward, working with other field builders. But the GIIN's 10th anniversary provides an excellent opportunity to reflect on the past 10 years. So what have we learned? We've learned that we need to mobilize much more capital, and that some long-held beliefs about impact investing are simply not true, that are standing in the way of sufficient capital deployment. For example, we have now proven that financial trade-offs are not necessary, although excellent fund managers are. We now know that impact investing isn't its own asset class. It can span across asset classes. And we know that impact investment isn't just needed in emerging markets. It can be just as effective and much needed in the developed world as well. It's time we dispel these myths once and for all, so more capital can come off the sidelines and get to work on the social and environmental issues. Andrew, what's the number one myth you've had to address in order to persuade UBS to mobilize more capital for impact investing?
The number one myth, I think, is around performance, and specifically whether there's a trade-off between targeting intentional impact and delivering market rate returns. The scale and the size of the social and environmental challenges facing us today is so significant that it really does present the opportunity for commercial solutions that do deliver on both the return side as well as on the impact side. And I think we're seeing that the example set of case studies of individual investments as well as pooled fund solutions that deliver on both of these premises helps us to really reinforce this notion. So while not all of the challenges out there can be addressed by market rate return capital, we do think that the question about performance is really no longer one that should be debated.
VENKY, as a market rate fund manager in India, what's the biggest myth your organization, Low Capital, has had to dispel when you're fundraising?
See, about 15 years back when we started up, when we were approaching the LPs, there was a lot of confusion in the market that are we really a not-for-profit organization? Are we doing philanthropic work, or are we really a commercial investor? And 90% of the conversations used to end within the first 15-30 minutes where people were not really convinced about what we were going to do. And today that has changed substantially, and backed by our fund performance, clearly that is about 75% of the people whom we talk to today entertain us with a second meeting. And I think I would say the large reason behind this is the impact orientation backed by the fund performance, which is critical for the success and for us.
Over the last decade, we've seen the financial markets make major steps towards integrating ESG risk into portfolio considerations. But there's not yet enough understanding that this is not the same as impact investing. That is, not the same as focusing capital on solutions to social and environmental challenges. It's time more ESG investors added impact investing to their portfolios. Hannah, how does Nuveen think about the relationship between ESG and impact investing?
At Nuveen, we do see these as related but distinct concepts and practices. So we actually use the umbrella term of responsible investing, and we include three different things under that. So we have ESG integration, engagement with companies and the market on ESG best practices, and impact, including impact investing and measurement and reporting. So what's the difference for us? Well, for one thing, ESG considerations do tend to focus more on company practices and behaviors that help those companies mitigate risks and respond to and take advantage of particular opportunities and thereby enhance their performance. While impact is focused on the tangible results of company operations and their products and services for people and the planet. So actually, I think all impact investing should also include ESG considerations just as part of good investing. But it does take it a step further in terms of defining and managing toward specific impact goals and solutions for social and environmental problems.
Despite a decade of growth, there are still not enough suitable products for impact investors whose strategies require very large ticket sizes. It's time institutional asset owners and asset managers work together to develop more products. In fact, impact investing is not accessible enough to investors of all sizes. Sade, how does AXA source suitable institutional grade investments?
At AXA IM, we set ourselves an objective of bringing institutional investor participation to the impact space. We do this firstly by building a team of professionals with impact, financial, and operational due diligence experience working together to review opportunities. We've built a high-touch process, over time reviewing over 500 opportunities and working to educate impact funds and businesses on the standards expected by institutional investors. But I want to end on a more optimistic note on the supply side. With the introduction of the SDGs, the increasing climate focus following COP21, what we've seen is a significant increase in opportunities, increase in funds, and new entrants of institutional grade investors into this space. So our focus has shifted somewhat. It's not just about looking at whether opportunities are available, it's ensuring that those opportunities are credible, not just from a financial perspective, but that we do not lose that focus on impact, which is really about improving the lives of people and outcomes for the planet.
We've learned that we need to safeguard the integrity of impact investing. Over the last decade, we've accumulated enough experience tracking impact that is no longer acceptable to make impact decisions based on instinct alone. It's time all investors started using evidence-backed data sets. Credible, comparable data is needed to inform impact investing decisions, so investors will know whether they are actually achieving the impact that they are seeking. The challenges the world is facing are too urgent for impact capital to underperform. Guesswork around impact must become a thing of the past. Mike, how does Root Capital approach impact measurement and manage impact based on evidence?
We've been lending to agricultural businesses for 20 years, and we've gone through a variety of approaches, starting from more intuition-driven approaches to having simple scorecards and narrative approaches to impact, and in the last 5 to 10 years have reached a scale where we can actually have replicable data-driven tools that systematically look at 21 different indicators of impact for each loan that we do. That helps us understand, for the loans we've already done, which are having more or less impact, and if the loans we're considering doing in the future, where can our money be most impactful. So these are drawing on publicly available databases on environmental conditions like water scarcity and soil degradation, on the levels of poverty that people are living in different countries, on data that we collect ourselves as part of the due diligence process, and that we can now benchmark against our own track record to see how do the loans we're doing now compare to the ones we did 5 years ago and the ones we hope to be doing in 5 years.
The GIIN's definition of impact investing: investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return, has served the industry well over the past decade. But if we are going to safeguard the integrity of impact investing as the market scales, it's time to recognize a set of core characteristics of impact investing that will provide the financial markets with more clarity about what constitutes expected practice. Neil, what do you think are the most important core characteristics of impact investing?
I think it's important that impact investors are transparent about how they go about their investments. They're transparent in explaining how they select their investments, what their impact they're aiming for, and what their thesis is of how they make a contribution to impact. I think the more that asset owners can understand transparently how impact investors operate, that's going to build confidence in the market and bring more capital to invest in impact assets.
JACCO, Triodos has been practicing impact investing for several decades and is well recognized for its ability to capture stories about the impact of your investments. Why is it so important to tell stories?
Let me tell you a story. I used to work in Cambodia, and Cambodia is a country that now has Acleda Bank. Acleda Bank, where In Chani is the chair, and Sok Panari is one of their clients, and we put them together and they talk to each other. Then you hear the story about how they both grew up in the refugee camps. One of them went on to set up the largest bank in the country, and the other one is benefiting from its services. Now what we do now is we communicate, of course, on the metrics of this investment. We communicate how many clients they reach, what percentage are women, what percentage are rural customers. That way we talk to the minds of our investors. But what we have to do at the same time is we have to make them understand the theory of change behind this investment, and that is what the story does. That way we are talking to our investors' hearts.
SAADIA, Rockefeller Foundation, has been involved from even before the conception of the GIIN. What has Rockefeller been working to achieve? And what are your reflections over the last decade?
In the early days, a lot of our work was focused on building the basic architecture for the impact investing sector. A lot of the institutions that could define what impact investing is, how impact can be measured, creating organizations such as the GIIN that could carry that work forward. In more recent years, our efforts have moved over to finding the innovative and catalytic solutions that can allow investors to directly invest in programs that can have social and environmental impact, as well as deliver on their financial expectations.
It is for sure the most exciting journey the GIIN has been on over the last decade, which has brought us to this important place in the market's development. With all that we have learned, the time is now for us to focus on key actions for the future, to mobilizing more capital for impact investing, to safeguarding its integrity, and to catalyzing a movement by sharing our experience of the power of capital as a force for good with others all around the world. Our vision is of a world in which financial markets serve all people and the planet, where finance plays a central role in solving the social and environmental challenges facing the global community, where investors integrate impact into all decisions. In this future, investors help to build strong communities. Investors help to create a healthier environment. And investors help to ensure a sustainable future for all. Impact investing can lead the way to this future. Please join us.